Well, the FNB House Price Index for March showed further slowing in its year-on-year inflation rate to 2.2%, while quarter-on-quarter house price growth has started to show early signs of improvement. And here to discuss these findings with us is John Lewis. He's household and property sector strategist over at FNB. John, thanks so much for joining us this afternoon. So a distinction there between year-on-year growth that we're seeing and then quarter-on-quarter improvement. How's that leaving you feeling at this stage? Optimistic about the road ahead or not so much?
Mildly optimistic, I would say. Firstly, it's better to look at month-on-month or quarter-on-quarter growth rates as a sign of near-term or sort of recent momentum in growth, as opposed to year-on-year. Year-on-year growth trends only turn with a bit of a lag after the month-on-month and quarter-on-quarter trends start to turn. So we look at those shorter-term growth rates for signs of momentum change, and there is perhaps a small sign of it. A slight quarter-on-quarter decline in the fourth quarter of last year to a slight positive, a 0.4%. Now, that's not a heck of a lot. It's not significant yet. It is a turn. But more significant is what we've seen in our estate agent surveys. Now, estate agents normally feel trend changes before the rest of us do. And they are pointing in the first quarter to a noticeable increase in demand and also a significant percentage citing stock constraints, which is also obviously a positive for market performance. So the agent survey pointing to a better picture, and I would think that in the next few months, quarters, you should start seeing some improvement in house price growth, although our year-on-year growth rate is not reflecting it yet, but that would ultimately lead later in the year to a turn for the slightly better in year-on-year house price growth.
John, talking about estate agents, I was on an aeroplane a couple of days ago and I was looking in the In-Flight magazine, and there was a house being marketed by one of the most prominent Cape Town-based estate agents, and it was for 125 million rand for a house on Nettleton Drive, I think it is, at Clifton, a couple of bedrooms, bit of a view of the sea. That's all very well. What I'm sort of trying to get to here is, as we've had a bit of a decoupling theme on the show today regarding markets, stock markets that is there also a decoupling in the South African property market? In other words, those super wealthy, the super wealthy market, the super rich market, and the bottom end of the market doing quite well, but in the middle of a bit of a malaise, if you like.
Lindsay, that's a tough one. The sample size when it comes to those super wealthy properties is so small, it's difficult to determine trends. But I would say, I would guess that with the global recession a few years ago and a couple of years thereafter, I cannot believe that the super wealthy market wasn't also affected. Those people do see a dent in their wealth every time the world economy goes belly up. And also, since the end of the global property boom a few years ago, property just wasn't the flavor of the month, even for these very wealthy investors. So although the numbers are very small, that 125 million property, its sample size is just too small to determine any trend. But I would think that they were also negative, or that part of the market was also negatively affected, as was the very low one, the affordable segment. But yes, that in recent times there must have been some improvement because the global economy has been growing again for a couple of years now, and that gradually inspires confidence in property investment over time.
To what extent can we extrapolate from what the example Lindsay cited and take it through to the expectations sellers have in terms of what they'll be able to get for their property and what buyers are willing to buy at?
Well, we're still seeing a lack of price realism according to our estate agent survey. Now, it's a very subjective thing as to what is a realistically priced market. But back in more solid times, the average time that a property was on the market was down 2 months or lower. And I would say 2 months is probably a reasonably good benchmark. When the boom ended, that average time on the market shot up to somewhere around about 5 months at some point. It improved very slightly, but is still hovering at up and down roundabout levels of 4 months. So I don't think that's realistically priced yet. I still think it's got some way to go. And then the other indicator with which we try to survey in our estate agent survey is the estimated percentage of sellers having to drop their asking price. And that's still up in the high 80%. So yes, I know most sellers, they've learned from trade unions, start the bidding high and then come down a bit. But in better times too, that percentage was down nearer to 50%, and a very significant portion were getting their asking price. Some even getting more in the boom times. But that's not the case at the moment yet. So No, there's still some way to go. I don't think it's a realistically priced market entirely yet, and that goes for the lower end, the low income end probably more realistically priced, but there's very significant percentages amongst all of them that don't achieve asking price.
John, tell us about the behaviour of the banks. Can I go in proudly with my CNBC monthly envelope and say, John, I'd like to buy this house, please? You're going to give me a 100% bond without any deposit, or are you still being rather cautious?
Lindsay, 100% deposits do exist, and they have existed for a good couple of years since the end of the property boom. But having said that, yes, in the boom times, they were probably the vast majority, and it even got up to 106, 108% loans so that you could cover the transfer cost. Nowadays, those 100+ loans are scarce, and even the 100% loans themselves are probably still in the minority. They're not. I doubt they sort of 50% of loans yet. So, in a lot of cases, we do still require deposits based on client risk and property risk. But yes, 100% loans are achievable depending on the quality of the client and the property.
Oh, let's leave it
Just
there.
to summarise what you think is going to happen in 2013, John, sorry, Alicia, do you think a steady growth and a recovery from here on in and all the worst is behind us?
I think we're going to get slightly better in terms of house price growth, but I'm not looking for fireworks. We're talking maybe 4 or 5% average house price growth for the year, I think. We've still got a mediocre economy. We've still got a highly indebted household sector. So no, I think fireworks in the property market are still a few years away, probably past the next interest rate hiking cycle. I think that far. It's a long road for households to reviving their balance sheets to what they were perhaps a decade ago.